the logarithmic decay, little by little by little by little, and then bang. Are we at that point? Well, it sure feels that way when almost half of the available silver has been drained. But now that these contracts are being stopped, I think that this is something that is going to start to perhaps put great strain on the physical market, perhaps could put a run on the LBMA. Can't purchase futures contracts from New York on the LBMA. And so it's drying up the liquidity in London, where they would use a lot of the banks would hedge their positions in London with forward contracts, derivatives, paper. Remember, in London right now, there's 200 and roughly last week. I don't know, it's probably a little less now, but 279 million ounces of gold in London. Only 36 of that is available for delivery. The rest belongs to ETFs in the Bank of England. And that's standing behind 380 million ounces in outstanding spot contracts, 11 times nearly the number of contracts issued versus the amount of gold issued. And in silver, it's very similar. Roughly 270 million ounces of silver is all that's available of the 800 million. Now it's under 800 million, like 770, 780, because we saw 85 to 90 million ounces. That's what COMEX is on track for to be delivered for March of silver come into COMEX, almost all of it coming from the LBMA. And so and when you talk about 290 million ounces and there's available, yet they're trading 2.9 billion ounces of silver, again, at 10 times the number of contracts standing behind or the metal standing behind those contracts, 10 times the number of contracts. To me, what it really speaks of is the lack of trust in the LBMA system, that no one trusts that they'll be able to deliver anymore. And they're trying to tell us that it's a logistics thing. It's a lack of trucks and a lack of manpower. I think they're realizing that the exchanges are being bled dry. And maybe now what we see is COMEX trying to distance themselves from the LBMA. In the last 3 months, 128.5 million ounces of silver have been withdrawn from London. And so you're talking almost 50% of the float gone in the last 3 months in silver. So between the amount of silver and gold delivered, not to mention all of the others that are standing for delivery, but they're being told it's 8 weeks. It seems like they're turning up the heat. And maybe, just maybe, that rumor of Trump trying to stick it to the Bank of England is really true after all, because this is a very provocative move. And I think, it really does speak of the LBMA losing confidence globally in its ability to deliver. And this is the beginning. So I guess we'll see what the real reason is. Much like most of the things we've seen lately on the LBMA and COMEX, we can assume and surmise what the real agenda is. Mainstream would tell you that's not the case. I don't believe it. I actually feel that we are witnessing a shift from this paper market that all of us thought would never be broken into other hubs like Shanghai, like Moscow, like Dubai. These are cash and carry exchanges where the price setting is far more realistic, instead of a futures market where it's 90% paper and 10% physical, and no one ever stood for delivery. And you and I have been talking about this, and the logarithmic decay, little by little by little by little, and then bang. Are we at that point? Well, it sure feels that way when almost half of the available silver has been drained. And now they're saying it's logistics. We can't really get it over to you as fast as we would like. Demand for physical gold and silver is rising. And this is a move away from the Western markets. It's a big deal. We'll see how big it is. But yeah, I think this is something people really need to pay attention to, on top of the fact that it just continues to move higher. It seems almost every day now. Yeah, it's not as bad as it was. In gold, it was up to $84 an ounce at one point. Silver, certainly, it was bigger. But, if you look, like, for example, right now in China, as an example, when you talk about arbitrage, silver today was at last night was at $35 an ounce in spot in Shanghai. So there is arbitrage around the globe, but not as significant as it was a few weeks ago. Because it's becoming too difficult to get it there. So I think that that arbitrage, which would necessitate some form of expediency in getting the metal sent this way, when you're talking 8 weeks delay,
Hmm.
makes that cost or that extra vig probably not really worth the effort. But now that these contracts are being stopped, I think that this is something that is going to start to perhaps put great strain on the physical market, perhaps could put a run on the LBMA and really start to shift price setting and global awareness to other exchanges, in particular Shanghai, Dubai, Moscow. We've talked about this. Now, is this the beginning of that? Well, it sure looks like it could be. But the United States is now prioritizing delivery over paper, which is something wholly, completely different. Almost all the gold that has come over the 25 million ounces or so, almost all of it has already been delivered. So if this delivery continues, you'll see strains on COMEX as well. All I can tell you is that whatever is happening in London, it's the beginning of the possibility of an existential event for some of these banks that are massively short if they get copious amounts of delivery requests, 10 times the amount, 11 times the amount of paper versus gold. That's a situation I certainly wouldn't want to be involved in if I was a board member of one of these commercial banks. Yeah, and a lot of the banks who would hedge their positions would do so with unallocated contracts in London. So, you take these massive short positions and then try to hedge it with unallocated positions in London. That's not a good thing. It's going to, in my mind, start to really emphasize physical markets versus futures markets. And that's something that none of us would thought would have ever happened. Now, I guess we'll find out. But it's not just the United States. I mean, we've seen in India in January and February, 44 million ounces of silver delivered to India on top of all the silver they've been buying over the last 4 years. So, we're seeing China buy massive amounts of gold as well, and that's been well documented. China has purchased, what have they purchased? Let's see, I think I have that number. Central banks have purchased almost 1,200 tons in 2024 alone. So I don't have the exact numbers that China has purchased, but it's an awful lot. And look, the bottom line is that physical demand, de-dollarization, alternative exchanges, these things are all happening in real time and all at the expense of the LBMA. And it appears as though, I mean, if you take a step back and you look at it, they throw out the idea of tariffs, which really don't seem what it is to me, and which allowed for all of these exchanges for physical with fungible COMEX contracts into London, and the metal was flowing. And then I think they're starting to realize that this is deeper. So then they come out and say, well, it's not a T+1 anymore, it's T+8 weeks. This is a big deal. And it's a big deal because the banks that have been suppressing the price forever may just have lost the ability to do so easily anymore because they're not going to be able to offset these positions in London with massive unallocated positions when you have all these entities standing for delivery. People's Bank of China has added 600 tons of gold in 2024 that we know of, probably a whole lot more, not to mention what they purchased. But this heavily unallocated paper gold to physical ratio market is breaking. And when you realize HSBC, Scotiabank, JP Morgan, they depend on these derivatives and these unallocated this unallocated gold to hedge their positions. They're not going to be able to take these massive naked positions anymore, these positions that have allowed them unabated to manipulate the market. Because as I've surmised for a long time, there are entities starting with the BRICS and now the United States that are getting wise, I think, to just how important physical is in a game that's rigged. When you see Jeffrey Gundlach come out, the bond king, saying, $4,000 gold is easy and in the cards, you're beginning to see a lot of big name people understand exactly what's happening. And, $3,000 gold, if we see these trends continue, will be a distant memory. And I don't really talk that way, but it just seems as though these are the kind of things that could certainly push gold a whole hell of a lot higher. No question about it. Well, I find it interesting that JP Morgan has taken over almost entirely full custodianship of GLD.
Hmm.
I think that in and of itself is somewhat nefarious. It was always HSBC Bank. I believe HSBC Bank only holds about 2 million ounces of the entire stock of GLD. Um, yeah, I mean, you could see the price of GLD go much higher just following the price of gold, but that's not the way to own it. It just isn't. And when people have asked me, do you think gold will be confiscated? I've said it forever. I think they'll take the ETF. So if we are indeed trying to reshore all of this gold and you put, in essence, the agent of the US government, that being JP Morgan, um, in charge of the largest stockpile of silver in the world and one of the largest of gold, and none of us can take possession. It just seems like it would be easy if they make this switch instead of confiscating physical gold, activating eminent domain to disclose those funds and give it to the U.S. government. Held by, JP Morgan's holding more gold in their two vaults, one in London, one in New York, than the majority of the G20 countries. So to me, I get nervous when I think about GLD and SLV as a tool um, to siphon a lot of that gold and to confiscate it and add it to the stockpiles. And if they really are trying to revalue gold, I did a little exercise the other night. I took the total US money supply and took 40% of it. And the reason it's 40 is that, look, the United States was on a 40% gold back. It used to be 100%. And then somewhere in the 50s, they passed a law that made it 40% until 71. When Switzerland had gold backing, it was 40%. When the BRICS just proposed their new unit settlement token, it's 40%. Jim Rickards was talking 40%. So I took the money supply, 40% of it, the total money supply, and divided into the amount of gold, or divided the amount of gold into it that we supposedly hold that hasn't been audited since 53. And it came out to over $12,000 an ounce. Now, could that happen? Yeah, why not? I mean, you're still talking 20%, nearly a little under of what Bitcoin got to. So why not have gold at 12,000, which would give the Treasury general account 3 trillion free and clear? They would just issue new gold certificates to the Federal Reserve, which, by the way, Federal Reserve does not have claim on any of that gold. There's confusion. People think that they do. They don't. The certificates that the Treasury more or less sells to the Federal Reserve or gives to the Federal Reserve as collateral for the money that goes into the Treasury general account is more or less guarantee on fiat currency. It's not the actual gold, which does belong to the Treasury. But if they revalue it to $12,000, giving it in essence a 40% gold backing, in line with where you would probably have to put it to do what Judy Shelton wants to do with backing the treasuries, collaring them and redeeming them in 50 years for gold, the first thing you would do is reshore it quietly so as to not let everyone know what you're doing, to allow the banks in the West to clean up their balance sheet in London, especially. And then you would slowly turn up the heat, get as much of it as you can, let the price rise, let JP Morgan control both GLD and SLV. I mean, you can see the pieces are in place for if they wanted to do this, they really could.